In this section, we're going to discuss the founding principles of the entire active growth investing strategy. Ray Dalio, in his fantastic book, Principles, Life and Work, he mentions that he wished that he had all of the guiding principles of the past great thinkers. And I really appreciated that view of the world. And I built this course not only to teach my method, but to teach you how to think and adapt. You know, I attribute whatever success I've had to being adaptable. It's not only the techniques that count, but the knowledge of why that technique is used and how to adapt to change that is so important. For when I first started trading professionally, there was no high frequency trading, there were no algorithms. Those were new when they came on. And that completely changed the landscape. And I was only able to adapt because I had a very strong understanding of all the tools that I was using. And even though I was day trading primarily, some of William O'Neill's key principles, such as limiting risk and controlling that aspect of your strategy, really helped me adapt when things were not going well. The way I learned these principles and identified them was by tearing apart my own work over and over again, as well as reading William O'Neill's How to Make Money in Stocks so many times and focusing not only on what the techniques were, but why he was using them, why they were built that way, and what were the driving forces behind them. Once you have that knowledge, you can really adapt them and use whatever tools are necessary to achieve your goals. So I really want to articulate them. So similar to Ray Dalio wanting to know other people's principles, you can take these principles that I use in my strategy and adapt them to yourself as necessary. Because you're not only blindly following something that I'm showing you, you know why I'm using it. And in my point of view, that's more important than the tool itself. So the first principle I want to discuss is that this entire strategy is driven by the idea that freedom and capitalism are what drives innovation, new technology, and profits. Every investment we make will be based on growth. New growth is less understood, and more importantly, it's under-owned by major institutions, and that creates an opportunity for investors. So why, when looking at the active growth investing strategy, why don't we just buy these great growth companies and let them advance and not worry about all the active part? Well, high performance trading really requires maximizing the risk-reward relationship. And of the two components, the only one you can completely control is the risk. And that brings us to our second principle. Limited risk is absolutely paramount. I mean, if you don't explicitly limit your risk or articulate it, your risk is really 100%, because whether you acknowledge it or not, that stock can go to zero. And 100% is absolutely unacceptable. Capital is the lifeblood of investing. And not only is losing the money unacceptable, the opportunity cost of a major loss is also just as bad, because you're stuck there with a loser, unable to make more money and redeploy that capital to better investments. And as we saw earlier, your risk directly impacts the kind of returns that you need to be profitable. Survival is mission critical, so you want to build failure into the system from day one. If you're just buying a bunch of growth stocks because you expect a long-term return, well, what if you're starting in 1999 and you're about to have a market come down 80%? Or what if you started this strategy in 2007, right before the financial crisis? You never know what's coming for you next in the marketplace. So risk is really mission critical and an absolutely core principle to the investing strategy. The third principle we'll look at is quite simply no stocks below the 200-day moving average. Now, when I was reading Market Wizards and pouring through that book, this is something that Paul Tudor Jones mentions. And I thought it was so simplistic yet so effective. That simple rule allows for some key points. Number one, you have to follow the trend. If you're below your 200-day moving average, whether you like it or not, you're below the relatively long-term trend of the past 200 days. And this also prevents excessive losses. So if you have this simple rule, even if you had no specific stop losses on your stocks, well, if it's no stocks below the 200-day, that means there's only so far down a stock can go before you'd have to sell it. Focusing on stocks in an uptrend is really focusing on stocks that are proving to be successful. The fact that these stocks are advancing means that the market is recognizing that the stock is undervalued and is already starting to appreciate the price of the stock. And at the end of the day, we really buy stocks. We're not buying companies. And so the only good stock is a stock that goes up. You can have the best company in the world, but if you buy the stock at 100 and it falls to 50, that was not a good stock to buy. The fourth principle is demanding asymmetry. So I limit all trades where I don't see a 5 times reward to my risk. If my capital is going to be at risk in the marketplace, I need to be adequately compensated. Some people find it difficult. How can you know what your upside is going to be? I mean, you know what your risk is, but you don't know what the reward will be. Well, that's true. But as we'll get into a little bit later, we'll see what typical moves are for the stocks that we're dealing with. What can we expect on the upside when the right conditions are present? And you'll see that in many times, much greater than 5 times our risk is possible. So I think that's a minimum threshold that you should pay attention to. And there are technical ways you can figure out if that's possible or not. And if you're in there for very small gains versus your risk, again, if you go back to that formula we looked at earlier, that directly impacts what kind of profitability you're going to have. So taking that step back and looking at the asymmetry, demanding much bigger gains than your losses, is absolutely critical in allowing yourself to build in failure into the system and being profitable in all types of market situations. The fifth principle is that we have 2 main elements to the strategy: fundamental analysis to find high probability growth companies, and technical analysis to time and allow for risk management. Again, growth numbers are not enough. The first real great growth stock that I bought was Netflix back in 2010. And they had a fantastic story, and they eventually turned into the huge company that they are today. But after the 2011 top, there was an 80% drop in the stock. Even though the entire story was intact, at that point in time, investors were fearful, and there was an 80% drop. So along with the growth, you absolutely need that risk management. And that's where technical analysis really comes into play in allowing you to deploy risk management. In order to apply technical analysis, you need price and volume data. And for that reason, I don't buy IPOs or SPACs just as they come to market, because there's just no way for me to really limit my risk when they first start trading on the marketplace. You don't have to stay away from them permanently, but you want at least 3 or 4 weeks of trading activity so you can find a good point to limit your risk if you're going to be entering that stock position. The sixth principle that most investors don't give adequate attention to is that the Federal Reserve is really what drives bull and bear markets. They are the underlying force that really shapes the entire capital market system. And without adequate understanding of the Federal Reserve, you'll definitely be at a loss in adapting to when they make moves in the marketplace. We'll be diving deeper into that in the market section, but it's just really important that you know from the onset that the Federal Reserve really is the author of bull and bear markets. The seventh principle is that institutional accumulation drives individual stock moves. Now, whereas the Federal Reserve is all powerful when it comes to the general marketplace, your stock's individual future is most likely going to be determined by institutional adoption. For example, if you take a look at the Fidelity Contra Fund run by William Danoff, it's a growth-focused fund with $135 billion under management. Now, if they want to allocate 1% of that fund to a stock, you're talking a position of more than $1 billion. Now, not every stock is a Netflix or a Microsoft or an Apple worth $1 trillion or two. If you're looking at 10 or $20 billion companies, a $1 billion position is sizable, and you can't buy that all in one day. The individual investor has a rather big advantage compared to these large funds in that we can move in and out of stocks with ease. However, for these large companies to take a position, it takes weeks or months of buying to establish it. And for that reason, these large institutions typically avoid illiquid stocks, so stocks that don't trade a lot of volume every day, or low price stocks. And so as a result, our system is going to be focused on stocks that are higher in price and have adequate liquidity. And it just stands to reason, if these are the big funds that are going to determine the future of these companies and provide these long growth trajectories, we need to be looking in the same pool of stocks that they are. The eighth principle and the last principle is really tied into the concept of risk once more, but I just felt it had to be discussed anyways, and that is the fact that leverage kills. So the more you put on leverage, the more you borrow money to invest from your broker, the higher the chance of your ruin. And that really grows exponentially with leverage. Now, I use leverage in my investing. I don't use a significant amount of it, but I use it with caution. I know that it's very hard to go bankrupt if you limit your loss and you don't use any leverage. The more leverage you use, the more you're exposed to black swan or extreme adverse events. And for that reason, that ties into the fact that your position sizes should be tied as a fixed amount of your account, and everything you do should really be focused on controlling the amount of risk that you take. We're finally about to jump in and look at what drives these big, huge stock market moves. And now we have a framework. We know how to think, how to approach the market, what our mindset should be. And we're really ready to get in there and figure out what it takes to find these big winners. Now, most investors just keep searching for that special buy signal. But the reality is, like we've looked at, success comes when the whole system works as one. Just like no team can win a game without any defense, only on the offense, you can't be worried just about when to buy a stock. And so with that in mind, the active growth investor strategy will be a strategy that you can customize to your goals and will cover every element of what you need for success. So let's dive in.